Good evening. I'm Charles Brown with CB3 Financial Group, and welcome to our first ever Facebook Live session. I've been emailing my clients over the last few days, and indeed every month we do our monthly newsletters, but I had promised a very long explanation today for what happened in the markets, but I had enough people call me that I thought, maybe I ought to just go live and show you just a few slides of what I'm thinking about and what I'm trying to measure as far as what's going on here in the markets, and then give you a chance to talk to me. So those of you that have been with me for a while know that I do the financial fireside chats. This will not be that. I only have just a handful of slides, and candidly, I only put this together just a few hours ago because things are happening so fast right now in the markets. But I'm aware that a lot of you are very concerned. And so what I wanted to do was just step back when the markets are closed, look at what's happened since the lifetime highs, which were just weeks ago, and to observe now that we have ended officially the 11-year bear market. I'm kind of killing time here a little bit, just talking to those of you that are already online as we wait for other people to join us, and I'll start the actual presentation in just a few minutes. But March 9th, 2009, the S&P 500 closed at 676.53. That was the absolute low of the bear market. Now, we didn't know that at the time, of course, but we can look back and see that. We can now look back and see February 19th. It's probably going to be the high for this bull market. And interestingly, that happened in February, and the March 9th anniversary of the low was just amazingly 3 days ago. It's been a great run, and what has happened here is a highly unusual situation, which I'm going to talk to you about tonight. So the single most objective I have for doing this live chat here on Facebook is just to put your minds at ease and to let you know, just like I was in 2008 and 9, I'm going to be here for you this year. So I'm going to switch to my slide presentation here. It's very short, and let me see if I can get that done. This is my first time on here, so what I want to do is find a way to share my desktop, and not quite sure how to do that. I thought I was sure how to do that, but okay. I'm hopeful that you guys can see that now. Send me a text or something in the chat box and let me know. You should see a slide that has a fireplace. I'm using the same picture from my fireside chat. Okay. All right, still waiting for a few more people to arrive here. Okay. And then we're going to take this live with the presentation. So okay, you're not seeing the slides. I've got to figure out what to do here. Hang on just a second, guys. Hang with me. Again, this is our first time, so we practice this. All right. I'm going to stop the video, and then you may need to log back in because for some reason the slides are not transmitting here. All right. Still got people joining, so just hang with me here, guys. We're trying to get these slides to transmit. You should see the picture anyway. You should see me, I hope. Seeing a few more people on here. Okay, so You guys should see me. You should hear me. And we're just trying to get the slides to move here. Not sure what's going on, but we'll do our best to get there. Best laid plans, right? Still got a few people joining, so what I may need to do here, if I can't get the slides, is I'll just continue because I don't want to keep you guys. But I can always send these out to you. So, all right. So here's what's going on. And again, you might be just seeing me and not the slides here. I can't really tell, but we'll get this figured it out. This is a picture of the S&P 500. And again, I'll send you these slides later if you're not seeing them. But basically, we hit a lifetime high just days ago. And now we are firmly in a bear market with this terrible move today, which was right at 10% in the Dow. If you're able to see the chart, you'll see that in the S&P and in the NASDAQ, we're still above the December 24th lows of 2018. And that's really important because that's a major turning point because the Dow has already broken that support. So the S&P and the NASDAQ haven't, since there's more volume traded with those markets, they're more important. So we're watching very carefully to see if the S&P and the NASDAQ can hold those lows. But the real question is, why is this happening? And what I have on the screen here, and I'm hoping you're seeing it, is a picture of a black swan. So there's a picture of a bunch of white swans and then a black swan. And the chances of seeing a black swan at the park when you go for a walk is somewhere in the 4th or 5th standard deviation. In other words, way less than 1/10 of 1%. So this kind of market event is highly, highly unusual. In fact, there's really no precedent because the last major pandemic that we had, the Spanish flu, took place 104 years ago when there really isn't a whole lot of market data. So here on the next slide, and again, I don't know if you guys are seeing this, but I've got 6 black swans because I couldn't find 4. What we're showing here is that there are multiple black swan events going on at the same time, and that's what I want to spend some time on tonight. Again, this will be a short presentation. I'm not going to keep you the length of a regular fireside chat. But on this screen, we've got the coronavirus, we've got a potential recession, we've got negative interest rates that are pervasive around the world, and actually the 2-year in the United States Treasury market went negative earlier this week. And then oil prices. So we have this confluence of highly unlikely scenarios happening all at the same time. So what I'm showing on this slide is what I'm calling the baseline, the good and the ugly. So it's kind of like the good, the bad, and the ugly, but the baseline. So if you're going to predict a range of future outcomes, you got to begin with a baseline scenario. So my baseline scenario for this particular black swan event, and I'm talking about just the coronavirus because that's all we're going to cover tonight, is that mostly the death count stays in China. We're also starting from a baseline that Europe and Japan are going to have negative GDP. That's almost a certainty, but this country is not necessarily going to. We're going to have rate cuts. If Jay Powell will do what he should do and lower the rate down to basically 0.25, even though we have rising GDP and the US has rising oil demand. Now, again, I'm not sure if you guys are seeing this chart or not, but I'm just telling you what's on it. So the best case scenario for this particular black swan event is that we have quick containment. Now, that, of course, is what President Trump has immediately implemented. I should say immediately. He mentioned it last night, and now today it's going into with the canceling of the flights to Europe, and then practically every sporting event in America shutting down, including Sally's Bakery down the street. I mean, we're seeing staycations and social distancing. That word, I'm sure, is going to appear in the dictionary at the end of the year. The best scenario is that there's a quick containment. The U.S. immunity system kicks in, meaning that we're healthier than many of our world counterparts, and that we don't have the rise in sickness that Italy, for instance, and China and the other Asian nations have shown, and that the U.S. and Iran oil conflict does not develop any worse. The worst case scenario, or the ugly one that I'm calling here on the chart, if you're seeing it, is a global outbreak of this coronavirus. Now, we have a global appearance of the virus, but it's not an outbreak. We don't have hundreds of thousands or even tens of thousands of people dying. The additional ugly outcome would be that the US and China have negative GDP. They're the two biggest economies in the world. And if that happens, then that's almost certainly a worst case. Negative GDP then leads to what we call ZIRP. If you're seeing the chart, ZIRP stands for zero interest rate policy, meaning no interest rate paid on fixed income and even negative interest. So I'm going to the next slide. And again, I'm thinking you guys aren't seeing this. I'm getting feedback that not. So I'm going to finish with these slides. Since you can't see them, I'm going to be brief with this. But my analysis is entailing, we're looking for what's called the peak moment, okay? The peak virus moment. That's already happened in China and it's happened in South Korea. So they're on the downswing. We don't know when our peak moment is. And you might think, well, gosh, let's have it as soon as possible to get this over with. Well, that's actually not true. We need to have enough deferment of the peak moment. And keep in mind, we can't control this. We need to have enough deferment that our medical facilities can keep up with the demand and prepare for what is likely to be thousands of people to be admitted to our medical centers, okay? So what are some of the scenarios? You remember I mentioned earlier, we've got baseline, bad, and ugly. Well, if the infections decelerate, I think we could see the S&P back above 3,000 again. I realize a gain of 27%, but we have seen that markets can melt up just as quickly or certainly as powerfully as they can melt down. That means that the peak of the virus is pushed out to the ideal place where our medical system can handle the onslaught, if it is an onslaught, of patients needing care, and that a vaccination is found and it's done. Because we are strong economically right now. If you just saw the February jobs report, which came out just last Friday, it's hard to believe it's just less than a week ago. And we had 100,000 surprise to the upside and 100,000 revised back to January. So economically, and I could mention many other statistically strong items, we're in great shape. The baseline, though, is that if this coronavirus fallout falls into our economy, causes recession here, and the medical system is overwhelmed, the S&P is going to be stuck about where it is right now, which is 2,500. Markets overcorrect to where they think the worst case scenario is. So the absolute worst case, in my opinion, would be if we have a redo of the Spanish flu, which could take the S&P down much farther than what it is right now, but still not as far as it was during the financial crisis. Now, that would mean that we literally would have hundreds of thousands of deaths in America. If you look back at the statistics, I won't bore you with them, but just Google it. And the 1914 endemic. We're just not in a position to expect that. For a scenario analysis here on the global recession, if we can keep this corona shock in a constraint, I still think we can be back near 3,000 probably by this time next year. And that assumes we keep positive GDP. If we have a short recession, and you might say, well, no recessions are short. Well, they can be. And besides, we have to have 2 negative GDP quarters. This first quarter is unlikely to be negative, although it's positive. The second one almost definitely will be. And we're hopeful the third quarter will not be. But the worst situation here, obviously, is that the consumer stops spending. Because the coronavirus by itself cannot take down the world's economy or the US economy. The coronavirus is a symptom, and if consumers stop spending, or if they are so embracing social distancing that they're not going out and spending money, then that obviously is going to affect consumption. Who's benefit during this? Well, believe it or not, Kindle sales. People are staying home and reading. So there are some positive outcomes here, but I wish you could see this chart. I'm thinking it's not working, but save your questions up. I'm gonna go back to my main screen in just a minute here. I'm just looking at the non-farm payrolls on this screen, and the last time we went into a recession, payrolls were negative in 2000 and 2008. That's every Friday. You know, I'm always commenting on non-farm payrolls. They were negative, deeply negative. Okay, they're positive. They're strong. We have a great number. This is a black swan event, folks. Housing starts is the other main barometer I look at because it's the main discretionary item. It's called discretionary, and granted it's lumped in there with refrigerators and going out to the movies, but it's discretionary because you don't have to get a new house. Housing starts were weak last time in 2008, and yet they're very strong right now. So the data that's happening right now, as far as lining up to past recessions, just isn't in sync. On the screen, again, I don't think you're seeing this, but the last recession we had in 2008 and 9, that was really two recessions, pardon me, that was two bear markets. The first one was from the 9th of October in 2007 to November 20th in 2008, down 51%. That's the one you remember. Then the market recovered, and it was down for 2 months, 27%, just from January to March. I think that is what this bear market could end up being. 2 months, you know, just not that big a deal. 3 months, 5 months. It just depends on what the consumer does, because the economic backbone of this country is strong. I have to say that again. The economic backbone of this country is strong. So I've got more slides here, but I want to go to questions because I don't want to talk too long here. I know I'm seeing no slides, guys, and I don't know what happened. We're going to have to figure that out. But I'm sorry for the technical snafu, but I am here. If you made some notes on what I said, I'm happy to take any questions that you've got here in the sidebar. So how is the virus affecting your daily life? For instance, I mean, just if you just want to make a statement, you know, I'm not going to identify anybody's names on here, obviously. So I would just be interested to know. I can tell you how it's affecting mine. I'll point down to show you my hair up here at the top. I'm losing quite a bit. The reality is, though, again, I see some folks on here that have been with me for a long time. Guys, we went through this in 2008 and 9. And we had a lot more reason. Back then, the Federal Reserve and the Treasury departments of multiple countries were meeting, hoping to stop leveraged debt. If you remember the tremendous amount of collateralized debt obligations, CDOs and mortgage securities that were just breaking the financial system. We don't have that now. We have a black swan event with a pandemic that no one really knows what the potential carnage is from this. And that's why our president took such drastic measures over the last 24 hours. I'm scrolling down here looking for questions. Anybody? How is it affecting you? What's it making you feel like? Are you looking at your portfolio and thinking we're going to be fine? I've had some people call me at night concerned, and I take calls, you know, as long as I'm awake and breathing. And that's been my promise to you ever since I started the business 20 some years ago. Would love to have any questions you have here. Okay. Let's see. So tomorrow, what are we looking at tomorrow? Well, we got inflation numbers today. And of course, nobody's paying attention to any data. You know, I could mention earnings reports, but it's almost a joke because none of the fundamental data, which would be non-farm payrolls, consumer price index, PPI, earnings reports, downgrades, corporate mergers, nobody's paying attention to that. It's all being traded on emotion. And I'm still waiting for some questions here. So let me just say this. For every seller, there's a buyer, and every buyer, there is a seller. So that means on these days when you see the market going down, somebody is buying down below. What it means is there are no bids where we normally are accustomed to seeing them, which is relatively close to where the offers are. What does that mean? The reason markets go down is because there are way, way more sellers than there are buyers. And what happened today, and has indeed happened the last 3 weeks, is there are way, 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 way more sellers than there are buyers. But there are buyers. Why is that important? Because as long as there are buyers, somebody is seeing value in the stocks that they're buying. Now you might say, well, gosh, it's much lower than it was when I bought it, and it may be. That's what a stock market does. It's about price discovery. And the market does this on a daily basis. The market, more than anybody else, more than your girlfriend or spouse or whatever, hates surprises. And a black swan is the ultimate surprise. And that's what has happened right here. And that's why I put this chart up for these charts that you didn't see, but I can send them to you. We've got a list, I think, of the people that logged on here. And, you know, it's just an unusual event, folks. It's not at all what happened in 2008 and 9. Now, granted, we don't know where that peak is that I talked about earlier. You know, it'd be great if the peak were behind us like it is with China and Korea. I mean, they're pretty much saying, I don't think the peak's behind Italy, by the way. I think that they've just done a bunch of things wrong, and they've had some hygiene issues they're going to have to deal with and change in their practices. But from what I can tell, the U.S. does not have the same exposure, no pun intended, that the Asian and European nations had, because relatively early in the curve, you could argue that, you know, President Trump should have shut down flights to Asia and Europe sooner than he did, certainly Europe. But we still had under 50 deaths. I mean, those are 50 people that, I'm sorry, had to lose their lives. But as I'm sure you all know, the comparison of the number of deaths just today from traffic accidents or the common flu, it's relatively small. What we don't know, and what the market doesn't know, is where we are in this peak. Are we close? Can we push it out enough? And again, we can't control this, so that the medical facilities in America can meet the demand when it's there, if it ever is there. But if it's there and people are literally lying outside in the street because they can't get into emergency rooms, and the market senses that, obviously that's a much, much worse scenario than what the market's sensing even now. As I said earlier, the market always overshoots. It overshoots to the downside, it overshoots to the upside. And in my opinion, it's overshot to the downside right here. So that's where I am on this. Again, I don't see any more questions. I'm scrolling. Whoops, we got a few more here. Okay, not too worried, but people are needlessly panicking. I'm going to like that because I think that's a great line. Do we see us getting out of this recession stronger? Okay, I've scrolled down here. I've got more. All right. I see one, buy toilet paper. Yeah, we just ordered like 60 rolls now. We ordered like 25 rolls, I don't know, whatever it was. Let me scroll back up here. And I'm sorry, guys, this is my first one. The second one will be smoother, I promise, okay? And I don't know about the slides. I'm really sorry about that. The stocks that are doing well right now, thanks, Tom. There are some experimental drugs that we think there are 3 companies that are in the running right now to find a solution here. The problem with investing in them is it's just like going to Vegas right now, and that's not what we do. We're not a hot stock portfolio manager. We're looking for stocks that can establish strong trends and give us a great risk-adjusted return. So good question, though. No chance to change my spending or financial planner. Okay, that's great. Here's another guy who says, I'm watching movies and staying at home. That's what I mentioned earlier about Kindle sales. I mean, a very well-known author had to move up the release of his latest book to, I think, a month earlier, because the demand was so high for it on Amazon for people that are, you know, deciding to stay home and read. So Okay, what else? You got, I didn't answer this one. Getting out of the recession stronger. Absolutely. Almost anytime something like this happens, Americans go, what can we do different and better next time, differently and better next time? So in the 2008, 2009 crisis, you can bet that the Federal Reserve, the big honchos that lead the major banks, the investment companies, the investment brokers, all the major players in the US financial system got together with the administration and said, we can't let this happen again. We got to put some structures in place. And so that happened. One of the things were these alarms, these lock limit alarms that happen when the market goes down 5% overnight or 7% in the morning. They got to actually hit twice of each, 5 and 7 this week. But we're gonna have some, and I'm not a medical person, but I think we're gonna have some cleanliness and sanitation standards increase across the globe, but certainly in America, to help prevent this sort of thing from happening again. I mean, necessity is the mother of invention. So I do think that's a positive outcome, and I do think we're going to exit the recession much stronger. A lackluster return where stocks will rise slowly. I don't see that unless, as I said earlier, the consumer just stops spending. Now, the consumer might change their spending. They might say, well, it's okay to go down to the local restaurant. I'll go there in off hours when we're not jammed all together. And I'm still going to buy my stuff on Amazon, and I'll go out driving on a trip rather than ride the train or get on a plane. I think the airlines and the cruise lines certainly have been repriced and may still be repriced because they simply don't know what is this fallout from canceling China flights, Asia flights, and now Euro flights. Mr. Trump says it's going to be a month. It could be 2 months, 3 months. We simply don't know. And it's that unknown, folks, that is making this incredible volatility in the market. I looked at my quote screen here in the aftermarket, and I saw one of it's not now, but earlier it was down 0.7. I said, gosh, it's already down 7%. And I'm like, oh no, the period's in front, 0.7, which used to be a lot. Now it's like, there must be something wrong with the quote. So is now the time to change asset allocation, or are we past that point? Is there value in reducing equity exposure, even maintaining a long-term view? A lot of that depends, and actually before that is a good time to buy. Well, if it's a good time to buy, it depends on your time horizon. If you're in the markets for 5 to 7 years and you're not going to touch this money, this is a great time to buy. We added some money. I wish I could tell you it was today at the low. It was actually yesterday. So fortunately, it was not a lot. We're doing some dollar cost averaging to our own programs. And by the way, we're still fully invested in all of our own programs. And those of you that are clients on here are with me. I can't, for regulations, talk about specific performance in this kind of broadcast, but obviously you can contact me later on to do that. So as far as changing asset allocation, I wouldn't be doing anything right now if you didn't need to. And here's why: because the spread between stocks, the bid asks, is so volatile, you're liable to just get terrible fills. And I would wait for an up day. We have done some trading this week on the 2 up days, not a lot. But if you look at relative strength in the U.S. market, there are always going to be some sectors that are doing better than others. When it's a risk-on environment, you're going to see technology, you're going to see industrials most of the time, not lately. Consumer discretionary, those are the risk-on sectors. And the conservative sectors, that would be real estate, utilities, consumer staples, are going to not do as well. Well, those sectors are now rotating back up because nobody's going to stop buying toilet paper and Clorox cleanser and consumer staples. They're going to go to Walmart and Costco. They might not go to the high-end apparel stores. So we're watching that all the time as asset classes rotate. And as sectors rotate within the S&P 500, we are making allocation changes. How are we sure that we are not going to have a second dip? I think it says deep, but I think you meant dip. We don't know that. We don't know that at all. We know that the biggest drawdown, other than the Great Depression, was in 2008 when the market dropped, depending on which market you look at, 53%. Again, there was a confluence of events that happened, and they were all financially based. This is not financially based. What a great time for this to happen. I mean, what if this flu had happened, folks, and we had just entered a recession? We'd had 2 negative quarters. I mean, the flu didn't ask us how the market was doing. The flu just decided to hit, but thank God, I'm sorry I'm going to say that, it happened when the country is strong. We're by far the strongest economy in the world. So if you're going to have a terrible thing like this happen, this is a pretty good time to have it happen. So I think that helps us in the long run. I'm interested in your question and Melissa's question. I think I got that. Now the time to change asset allocation. No, we passed that point. The time to change asset allocation is if you're just looking at S&P. I mean, you can look at this on a sector if you just drill down into equities, or you can look and say, well, I want to be less in stocks and more in bonds, or less in stocks and bonds and more in commodities. And when those asset classes are doing well, we do trade them. Those of you that are in our DG program, I can't mention specifics, but I can say, and now have a gold allocation, and you have had for not quite a while, but several weeks. Okay, because we see gold rotating, and even though it doesn't pay a dividend, we thought that the investors in that sector, in that program, needed to have some gold exposure. So I think I've gotten all of them, and I'm right at 30 minutes. I didn't want to keep you online too long. If you have any more questions, please put them in the chat box and I'll take them. Do I foresee the airlines and the cruise lines rushing to bring up their prices once the coronavirus scare is over? Well, those entities have A, been beaten down really badly, and B, if they don't get better prices pretty soon, they're going to have massive layoffs, which is going to contribute to the trickle effect that I mentioned earlier about consumer spending. And consumers, there are only 3 entities. You guys know this from my fireside chats. There are only 3 entities that provide GDP for any country in the world: consumer spending, corporate spending or business, and government spending. Well, businesses since the 2008 crash have been very, very frugal in how they spend and how they pay their employees, and the amount of stock that they keep, just-in-time stock. You heard that before. And that's one reason they have been so profitable for the last 12 years and buying back their stock when they can. So they're not contributing that much to GDP. And the government, as the current administration has tried to become more and more austere by reducing governments, well, not really reducing government spending, but reducing government employees. How about that? So that leaves the consumer to be almost 70% of GDP. And if the consumer drops, not because the others increase, but because if the consumer drops, the other one's just naturally, it has to equal 100%. If they pick up the slack, businesses and government, because consumers aren't, we really don't know what it's like to have consumers at a 60% contribution to GDP. I don't want to say that's a scary thought, because I think people are going to keep consuming. I think they know that this is a period of time and that fundamentally America is strong. That's one of my most fervent messages to you tonight. Not only are we strong as your advisor, our country is strong. This is a black swan event that will pass. Airlines, cruise lines. So will they bring up their prices? Sometimes I get off on a tangent here. Yes, of course they will. Anyone is always going to raise their prices to the absolute highest level to where the customer stops buying, and then they drop it. And then demand meets supply, and the capital economy goes on. Capitalism economy goes on. Any more questions, guys? Okay, so I'm going to sign off here, but let me just end with this. This is the first time we've done this, obviously, or you would have had some slides if I knew what I was doing. But I hope it's been helpful. One, because I want you to know we're on it. We're watching literally the markets every moment that I'm awake in these kinds of environments, just like it was in 2008 and 9, and portions of 11 and 16 and other dips in the last 12 years. Number 2, I want you to know that our country is strong. Our markets are strong. This is the best place on the planet to be if you are trying to build a portfolio for your financial future and if you're trying to stay healthy. this is the place to be, the United States of America. And thirdly, I am willing to do these kinds of chats as often as you would like them. If this is useful, either mention something here in the chat, shoot me a quick email, cb3@cb3.com. Most of you probably know that. But if you're new here tonight, cb3@cb3.com. Tell me what you saw that you liked, and let me know if there's something you'd like to hear in the next one. And just tell me if you want one tomorrow night, I'll do it. I kind of doubt that on a Friday night, but I'll send out notices, and we'll just try to do this to the point where you feel like you can sleep at night and your stomach's not in knots. Because part of what we do as your advisor is to bring comfort to you that everything will pass. I can't say everything's going to be great immediately, but 100% of recessions in the history of this country, back to the 1770s, have exited. 100% of them. And we aren't in a recession. 100% of bear markets have turned around to be bull markets. 100%. We just don't know when that'll be. And we'll be watching that for you. Thanks for tuning in tonight, guys. And let me hear from you. Let me know what you'd like me to talk about, and we'll stay in touch. Good night.